It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, second quarter earnings season. As you likely know, stocks have posted a strong first half of 2023, with the S&P 500 rising 16.88%. But while stocks have climbed, corporate profits have fallen. At the time of this writing, we're just over halfway through second quarter earnings season. So far, 80% of S&P 500 companies have reported a positive earnings surprise, meaning they've beaten Wall Street estimates, and 64% of S&P 500 companies have reported a positive revenue surprise. Looking at the sector level, 6 of the 11 sectors are reporting year-over-year earnings growth, led by the consumer discretionary and communication services sectors, and on the other hand, 5 sectors are reporting a year-over-year decline in earnings, led by the energy, materials, and healthcare sectors. That being said, earnings on average are lower than a year ago, with the average earnings decline for the S&P 500 at 7.3%. If 7.3% is the actual decline for the quarter, it will mark the largest earnings decline reported by the index since the second quarter of 2020. Despite what could be the largest drop in earnings since the onset of the COVID-19 pandemic, the forward 12-month PE ratio for the S&P 500 stands at 19.4. This PE ratio is above both the 5-year average of 18.6 and the 10-year average of 17.4, bringing into question whether or not fundamentals support the current above-average multiple on stocks. Number 2, credit spreads. Credit spreads, or the difference in yield between a corporate bond and a risk-free U.S. Treasury bond, remain extremely tight even as the Fed continues on its path to tighter financial conditions. Corporate bonds now yield only 0.12% above the Fed funds rate, the lowest level since 2007, preceding the global financial crisis. Looking at history, every time credit spreads were at a historically suppressed level, a hard landing scenario followed. Maybe this time it really is different. However, fundamentals are signaling caution as valuations based on credit spreads are not particularly attractive. For high-yield bonds, spreads sit 7% below their historical 20-year average at 481 basis points versus 519 basis points. Only CCC rated and below issuers have spreads above historical averages, as BB and B rated credits sit 9% and 2% lower than their 20-year averages respectively. Ratings actions and default expectations don't bode well for high yield either, as downgrades have outpaced upgrades for 4 consecutive quarters, and forecasts indicate default rates could be between 3% and 4% over the next 12 months. As we have learned repeatedly throughout history, tightening monetary policy works with a lag, and we are yet to witness a significant credit contraction that could lead to further economic issues. Either these macro indicators are on the brink of being proven wrong, or there could be some pain on the way. Number 3, inflation. The so-called core PCE rose 4.1% from a year ago, compared with the estimate for 4.2%. Headline PCE inflation, including food and energy costs, also increased 0.2% on the month and rose 3% on an annual basis. This is all continued evidence that the Fed's interest rate hikes are doing their job. However, several risks to moderating inflation remain, such as rising fuel prices and a housing market that could cause problems ahead. Inflation is certainly lower when including all items, but the move is less impressive when excluding volatile food and energy prices. Energy has tumbled nearly 17% over the past year and can turn around quickly as we've experienced in recent weeks, with the price of Brent crude rising from roughly $70 a barrel to nearly $82 at the time of this writing. Another factor that is key to the Fed's expectations that inflation will ease is the belief that rental costs will subside after a housing price boom in the early days of the COVID pandemic. Shelter costs, though, rose another 0.4% in June and are now 7.8% higher than a year ago. That's just off the peak earlier this year and still near the highest since the early 1980s. While we're optimistic that inflation will remain subdued, we'll be watching closely in August as the Fed prepares for its next monetary policy meeting in September. And that's been your Market Minute for the month of August. Thanks for listening.